Good day. Ira Epstein with your financial market wrap-up for this February 10th, 2020, and we're just getting on to 4:45 p.m. Central Time. Wow, what a day. The market took off to the upside, yet the silver held on, the gold held on, the dollar higher. It's such a mixed bag. People are trying to figure out now the yin-yang of this coronavirus. People are going back in China. Will that mean that more people are going to catch it in the factories? Don't know. As they go back, it's not going in one easy step. It's going to be sort of staggered as things go on. But the market's looking over the horizon saying, and I think properly at least, hey, if they're going back to work, that's a good thing. And at least the mortality rate from this is nowhere near the other two viruses that came out of China. At least that's what they know so far. The disease is spreading. France, Great Britain's got it. And go on and on. China, not China, Japan, it's a lot of areas. But the question is, how serious? Is it overblown in only the sense that it's a virus, you catch it, it doesn't have the mortality rate of what's in America? I don't know. I'm no doctor. But I can tell you, you're still weighing under the pressure of all this on the energies. Look at this nat gas. Just too much. I read the first article today that said that these low prices are eventually going to cause this market to bottom out. Very first article in a long time. Yet when you look at all the other parts of the complex, down as we're hearing that Libya could come back online and produce up to 1 million barrels a day. The Saudis and Kuwait, they're in pretty good shape in terms of they've got a joint venture that since 2005 has been dead, and now it's back alive, and this week they might start producing up to 10,000 barrels a day. Why would Russia agree to a cut in production on that? It's just still a lot of supply. But as I said, the market, a new all-time high close. That's the thing you can't argue with. The other thing on a weekly chart, if you use filters, I do. I use moving averages as filters, and it's the most simplistic way that I trained myself. One of the things is when the market's over a key average, and I consider the 18-week average the key, the market has an upside bias. When it's under it, a downside bias. All that means is it's filtering other of your tools. And one of the tools that I use at the filter is the swing line. Now, where we were is we had made a higher high than this if we take a look last Thursday. If you take a look at the S&P, it got up to 33.57. The market came back, and today the market's 33.50, 350. But on a closing basis, it's a higher close. Now, it is a Monday. I'm always aware of the fact that there's a word called Tuesday reversals. If you ever read the Stock Trader's Almanac, and I recommend you all do, it gives you some ideas. When you get a strong Monday, be it to the upside, or a very weak Monday to the downside, it's not uncommon that you get an attempt at a Tuesday reversal. We'll see. Right now, what's the swing line? Well, the swing line is still pointing higher with today's action. Take away today's action, you had a higher high and a lower low, but you have an outside day up today. Until the low of an outside day up is taken out the next business day, it doesn't have to be, but if it is, or the day after, I consider that a swing line low. If it stays in place, you've got higher lows, and you've already had the higher highs, as you can see. That's friendly. In terms of the 18-day average of closes on the daily chart, the market has now had 4 days staying over it, basically. Bias is up. Where's resistance? Right above the market at 33.71.5 is the upper Bollinger Band. So I would expect that if the market can get up to the Bollinger Band top, it runs into some, again, resistance, profit taking by the pros. We'll see if the market does that. And when I look at momentum, I'm more inclined to think that because you're overbought. Now, overbought conditions occur when the slow stochastic reading has a reading over 70 without both numbers going sideways over 80 for several days at a time. That fits in. This is called embedded. That's when it gets over both numbers, the 80 level, and it stays that way. That often is accompanied by momentum leading price in the market moving to higher levels. You're not at that point. You're at the point where you're overbought. You've come from a lower Bollinger Band. You hit the area of the upper Bollinger Band right here. The high on this day was 33.57.75. Just missed that upper Bollinger Band. There's no magic to it, but if you get there, I'm still going to look for the resistance to show up. What about the NASDAQ? Here's the difference in the S&P. Both numbers today are finished over 80. So that's the first day of trying to develop three of them to embed. It's still overbought. And a market that's overbought should have resistance at the upper Bollinger Band, 95.2750. You can see that's basically the market, that's the settlement. 95.1750 is the upper Bollinger Band. You're over it. You rarely spend more than 5% of the time outside of a Bollinger Band. You're in a resistance point in an uptrend. Why? Higher lows, outside day up today, higher highs. The market didn't resolve the trend as of Thursday and Friday. It kept this pattern of running the upper Bollinger Band with a lower low and a higher high. With the outside day up today, that could resolve it. Now, what would be the bad thing to occur? If today's low is taken out, then I'm going to look for price in the 18-day average to try to make a run at each other. Given that the market's overbought, the odds would be favorable to that. Does it have to happen? Of course not. Nothing on a chart has to happen. You're reading the patterns and trying to figure out what the probabilities are. In the Dow, you don't have the same pattern as the others. You have a market with a higher high, but you have this lower low. Again, the battleground's the 18-day average. Notice how on the bottom part, when you hit the Bollinger Band, you got up to it, then you slip back. When you finally got over the number, then you're looking for that 18-day average to possibly be the support zone. In other words, the neutral factor in the market. It went to it today. I'm not saying it's trending here, and the market's developed itself with an up day. So I have an overbought market, both numbers not going sideways over 80. I have a lower low, higher high, no trend on the swing line, upside bias. Let's assume the market takes a run to the upside. Possibly the upper Bollinger Band is the resistance. Where's the near-term neutral number? Where, if the market just let go to the downside again, would be the support, potentially back at the 28,278 down to the 100-day average. But you're neutral on the chart. In the Russell, this is the weakest of the stock indices. Now, what it tried to do today is get better. It's a market that's been weak as can be, fighting at that 18-week average, and it closed, if you'll notice, over the 18-day average of closes today. That means that if today's high is taken out, or if the market doesn't take it out but just doesn't take out today's low, you get the swing line turning up. Very important is that the market for the bulls, if they're going to turn bullish, see the market pick up here and take out this high. Why? You've already got the higher high. To get the higher lows, that would be part of it. And then what you wouldn't want to see if that number takes out that high is today's low taken out. If today's low were taken out and you first hit the high, that could be a trap for this market, kicking it right back down here. So I think I understand the game plan that's on. Now the question is, which way do the pros execute? In the VIX, we were looking for support against the lower Bollinger, the 18-day average of closes, and that's where the market went. It is now very much a market that's got a higher high and lower low, sitting at that 18-day average. Support under here is 1423, the 100-day average, and that's where I'm seeing it. So I see a market that stepped out of any trend at all. In the T-bond market, with all the hoopla and the rally, you still haven't gotten back up to the highs that you made back here. You're in an overbought market that I realize it sounds every day like you're trending, but you're really not. You got a higher high and lower low pattern. Very much the safe haven went on where people were buying notes, bonds, the gold, and the dollar today, as you'll see. In the 10-year note, it's the same pattern. Higher high, lower low. Again, you challenge the 18-day average, challenge that 18-day average zone. Market picked up away from it. What would be negative for this market is taking out last week's low in the notes or the bonds. That would put the market back into a downtrend pattern. In the dollar index, you now have today over the upper Bollinger Band. Day before, that's 2 days in a row. This day was over it as 3. Now this day was also, this day was over it is 4. You have 4 days in a row over it. It's rare that you settle 5 days in a row over. You can do it. You can go 6 or 7. I'm giving you the percentages. Go on your charts, and what I'd like you to do is count. How many times do you find that pattern? This is not a sign of weakness, so let's understand what that is. But it's like a market that's been pulled out and let go, and it might be in need of a correction. It's been in an uptrend. It had a bullish crossover. I think you'd agree with me on the moving averages. Watch this right here. You got the attempt to take out that high. Market got through it, and this was last Wednesday, and it hasn't looked back since then. Now, if they ever get good news on the coronavirus, you might see the dollar get a correction. This is the one thing that has got to be irking President Trump. He doesn't want a strong dollar. Eurocurrency, the mirror image, just a flip-flop. Lower highs, lower lows. But unlike the dollar, not spending a lot of time under that lower Bollinger Band. If we take a look at the slow stochastics, both numbers today were under 20 the day before and the day before. So you've got 3 days in a row. It means the market is embedded until the red line closes back over 20. I'm looking for the pros to sell this market on rallies. Could be people that are caught putting in orders. Hey, get me out of this. It's turned out to be a pretty miserable trade. You are down to the 109 level here. In the British pound, the first challenge of the 100-day average in the lower Bollinger Band often, it is not the word always by any stretch, but it often, you look back at it 2-3 days and you say, darn it, that was a support zone. That's what I'm looking for. The market is bearish, but oversold. It's hit downside targets. Is it going to be a breakout of this sideways action is actually what we have to ask ourselves. This is the bigger picture that you're looking at. This sideways action that's attempted a breakout to the downside, will it have any follow-through? If it does, it can go deeper than you think it can. So there's no reason to be bullish. There might be reasons that I think the pros took some money off the table, but I'll bet they follow it with tight stops. In the Japanese yen, you've had a reaction to this panic off the coronavirus that peaked at the upper Bollinger Band. You see that 2 days in a row. Came back down, stopped first at that 18-day average. Didn't spend a lot of time there. I'd like to have seen more time spent at it. Just 2 days that it hit it, and now it's trying to get back up to it. It is oversold. It would not surprise me if it wants to do that, but I don't see a trending market here. Bitcoin got up and over the 10,000 level. We've been talking that you've had the embedded reading. I think I've been very clear that the market has stayed since literally the beginning of the year over this 18-day average of closes, kept the upside bias. And after this one correction back here in late January, once you cleared this high, it's just had that pattern of higher lows, higher highs. And yes, I think that as you approach the Bollinger Band, the pros take some money off and they're trying to buy it back on the breaks. What I wouldn't want to see to break this pattern is taking out today's low of 95.10. That's because it's an outside day up, and that would hurt the pattern of the chart. In the differential between April Brent WTI crude, you're down to $3.49. You were just up at about 5.30 up here. So this market has just literally collapsed the difference between the two. And in large part, it's because OPEC keeps talking about cuts. And now that they can't even get the February meeting set up from all that I've read. It sounds like they're going to go into a March meeting. Russia doesn't want to join in so far with a cut. I don't blame them. You could have more Libyan oil on the market. Saudi Arabia and Kuwait are restarting a field from 2015 that has been idle. They finally agreed on how to manage it, and they're starting with 10,000 barrels a day. It can produce up to 500,000 barrels a day. So at this time, given the coronavirus, given the supply chain problems that's created around the world, you see that the energies have come down. There will be a number where it's too cheap. I don't know what that is, and I'm certainly not a bottom picker. Well, I'm going to give you what I'd be looking for. When you lose the embedded reading over 20, it's probably the sign this market has hit a real value area. WTI, as much as Brent broke to new lows, notice that you haven't done that yet in this market. It's not enough reason to say the market's not bearish. It certainly is. Lower highs, lower lows. You had a bearish crossover, and I'm sure I would have pointed this out. This happened last Monday. And that often leads to new lows, and you've got those lows immediately. And if you'll notice, the market hasn't really broken through that low again. It happened right off the bat. Resistance all between here. When you lose the embedded reading, I'll get interested. This is a hard market to want to get short after that large of a break. In the gasoline market, this market keeps trying to get into a rally mode and it just can't do it. But as it's going sideways primarily, if you really look back here, this has been a market that had one poke under those lows and it really hasn't stayed much under that at all from back then. It's letting the 18-day average come down to it. When you had the bearish crossover, and this was the red line getting under the 100, you're often looking for a new low to be made. It did what it had to do, but it ran out of steam right away. I see resistance in between these two numbers. I still say, got to keep your eye on the spring demand. It's around the corner. We'll see if gasoline prices can pick up. The good news is for the U.S. economy, think of how cheap our energy, be it nat gas, gasoline, everything's cheap. The consumer has more money in his pocket. Nat gas can't even hold the rally. It tried. This is an embedded reading. Here's a market that on Friday loses it. I think the pros got out of the market there. Would not surprise me. Now, the only time you can re-embed them is the day after you lose it. It's the only time. Otherwise, it's got to go through the whole process, and it typically could take another, even in a super bear market, up to another 4 business days. It lost it, and it gained it back today. So it keeps the reading. So this was a bull trap. The lower Bollinger Band is the next objective. Resistance certainly up at that 18-day average. And the market made just enough of a higher high and lower low pattern to probably take out over the weekend some of the bears. And now they're going, don't worry about what you don't catch. Worry about what you're in. And that brings up to me one of the tools that I look at during the day, especially on markets like this. I look at the pivot points because I'm looking, which markets can you enter, which ones aren't so stretched out to the upside or downside that make logical ideas for my clientele and so on as I put out my updates. So I look at this, and I taught the formula, and the formula is no secret. You can go out there on Wikipedia, you'll find the formula, but I do it in a video so it's easy for you to see how it's all done. I explain the math of it. You don't have to do it, but it's always nice to understand it. From the formula, lines are drawn, and I explain how that's done. I take you in the second video how to set the colors up on your chart in most cases to play with it. And what it really does is you're going to come out with a center number called the pivot. Then you're going to have a first resistance, a second resistance, a first support, a second report number. That's how it typically works out of there. And as those numbers come away back and forth from there, traders are trying to buy the support, come out at the pivot, sell the resistance, come out at the pivot, or sell the second resistance if it keeps going to even up positions. I explain how that works. It's primarily, folks, a day trade tool. You're not trying to take positions on this tool for anything beyond that. At least that's what I teach. In addition, it uses charts that are 15-minute charts. You go to a different interval. Now, I've seen people use 5-minute and 10-minute. Do what you want, but I like to do what the mass does so I understand where they're at. I apply to it the slow stochastic, so you get the oscillator telling you, hey, the market's at a resistance point, it's overbought, it's now turned down, maybe this is where it's going to pull back. There's a lot of chat rooms that do, I see this, I've joined some of them that talk about this and do it. So if you'd like to learn it, we've got a 3-part video, it's free. Go to our website, take a look at all our free offers. You'll see free offers there, do it. You can click up here, it'll take you right to the free offer section as well. I'm Ira, have a good day.